Okay, welcome back. So following up on what Bill said, we're going to solve a more mundane problem, which is to try to help you all stay in business. And I do have great respect for how hard it is to be a CEO. And last year I gave a presentation about using numbers to succeed. And I was challenged, I would say, by a few months ago, someone that was in this audience came to see me, and they said they'd watched the talk, and they were excited to show me that their financials had followed the talk and that everything was ready to scale. And some of you know me and know it's a real challenge for me to not betray my emotions on my face, but I did the best I could, but I was aghast because it was not following what I'd evangelized. But the founder really tried. And then I talked to the partner they work with at Khosla, and they'd said, like, what? Like, I thought everything was good too. So I thought, okay, I've got to do something differently. So I brought in my buddy here, Jared, who's one of the senior partners at a very successful tech growth investment firm, Dragoneer. And I talked to Jared about what is it that you see with the companies that you invest in that are making it. And he shared this expression with me that he's looking for companies that have nailed it but not scaled it. So then we got in a conversation about how do you know if you've nailed it? And that's the purpose of this talk, is to help you all know where are you have you nailed it, have you scaled it, are you matching your spending appropriately with where you are in that journey, and to give you a few more tools to use using numbers and financials to help you find your way on that journey. Now, before we dive in, I wanted to just briefly review the high level of what we looked at last year, which is that most businesses, most of you, will make a product that you end up with customers that like the product, it's got good gross margins, and you're able to put up some kind of revenue, ARR, momentum numbers. So that's most companies. But most companies still fail. And this is a very serious comment. It's not most companies outside this room. We want to bend the curve and make it that a disproportionate amount of you succeed. But the risk of failing is very high. So why is that? We looked at last year that it's because of these two phenomena. One is there's initial traction that doesn't scale. And so what I put up here in this sub-bullet is they thought they nailed it, but they actually hadn't nailed it. Then the second way that most businesses end up failing is they end up with this phenomenon that even though when they sell their product, it has positive gross margins, the business still never makes money and then eventually collapses. And that's what I put here. The cost of sales is higher than the contribution margin. And these two phenomena interact together. A business that thinks it's nailed it but hasn't and then scales, that business is going to fail. So we want to avoid that and not be those businesses. So now, again, for a fresh perspective on this, I brought in my buddy Jared, who works at, as I said, Dragoneer. And these are some of the businesses that they've invested in, where there's a disproportionate number of businesses that come in different shapes and sizes and different paths to that success. And so with that, I'm going to turn it over to Jared.
Thank you, thank you.
Thanks
also for having us go right after John Collison and Bill Gates. It's very kind of you. So at Dragoneer, we look for a small number of things. It's our belief there's a really, really small handful of exceptional businesses in the world. We work tirelessly to find our way to invest in those businesses, but what characterizes them is great teams building in really big markets, and I do the consumer internet investing, and especially there, you can have 2, 3, 4 billion people using your products these days. Building businesses whose moats deepen with scale, so they get harder to compete with the larger they grow, with wonderful economic models. And I think importantly here, it's not that you're generating a lot of free cash flow necessarily today, but that you will over a 5 or 10 year period that we can analyze. And that's the last point, which I think is why I'm here. We love data, we love analysis. We all came from more of a PE style training background, and so we love to really be able to take a company's data exhaust and forecast over 5 or 10 years and have real certainty in the future. So one of the corny catchphrases we use around our halls is something called nailed it, not scaled it, which is the first thing that came to mind when David and I started talking. And so I thought today, in Khosla honor and given their unbelievable investment in OpenAI, we would giblify our boring 2x2 and make it a treasure map. But basically on the top right, have you nailed it or not? or on the y-axis? Have you nailed it or not? And the question there is product market fit clear? Is the team fully in place? Are the unit economics analyzable or not? And we love to invest the millisecond after which that's the case, ideally. Although there are private companies where it's been nailed for a long time and public companies where it's still not nailed, which is why we do both public and private. And on the x-axis, are you growing slow or fast? And I think the really important part of this slide is to know where you are, not to fool yourself about thinking you might be somewhere else, and then not to shift up until you know you've gotten out of the bottom left successfully. Otherwise, you can trick yourself into making a lot of silly mistakes that are really hard to unwind later on. So, by way of example, Bird is a company that maybe you've all heard of. They lived in the bottom left for some time, but then very quickly hit the go button. And they were one of the fastest companies to reach 100 million of run rate revenue. They raised a ton of money at really big prices. They were pioneering the future of micromobility. And then they filed for bankruptcy, right? And so what are the learnings from that? I think there's a couple. The first is, just the core unit economics. They had lots of different cuts per trip, per scooter, per city, but with shaky premises that were changing all the time. And so it was really hard to nail down the root truth of what the business was doing in a given market. And then while they were still trying to figure that out and roll out new scooters and try different locations, they scaled super rapidly to, I think, like 350 cities. When you get to that place and you're focused on growth and scaling team and all the complexity that comes with that, and you divert your attention from the core nailing of the, let's call it per city, it gets really tricky to backtrack and right size and fix the base. And so that's an example where, this comes into play. And I think this is something that is really fun. I see it in a lot of decks. We see it in the press, and it's companies that can proudly say, hey, we've gotten to this revenue or GMV number faster than all these predecessor companies who have raised a ton of money and are now really famous. But the reality is, it is such an incomplete picture. What were your gross margins with that revenue? How much money did you spend? If you got to 100 million in revenue and spent 10 billion to get there, that's not that interesting. And I think it's okay to fake it till you make it. It's not okay to fake yourself out. So really being honest with yourself and knowing the core unit of your business and the ground truth of the business is really critical. We love growth, but to be clear, growth at a reasonable unit economic, durable growth is really what matters most to us. And so to that end, actually, going back to this, we've had 40 companies in our portfolio go public over the years, and actually even today, only 30 companies greater than 2 billion of market cap are growing over 30%. Something we've learned the hard way by studying this all is the primary determinant to building a huge business over time is not how fast you grow. It's whether you're in the top row or not. Have you nailed it or not? At the point where you've nailed it, grow as fast as you reasonably can, but no faster. And you will definitely get there. Whether it's in 12 years or 10 years is not as important as getting to that finish line over time. So I want to give two examples for the top right and the top left. The top right, I think, was talked about last year as well. But this is a business we led the Series F in 2019, I believe. And people were kind of surprised when we did it because I think they were, at the time, the conventional wisdom was this was a business and team that kind of were emblematic of the excess of the time. Super high growth, super high burn. Like, what are you doing? Surely this is a mess. And these were the sorts of things that people saw at the time. And if anything, I completely disagree. The team is exceptional, and they lived in this bottom left quadrant for some time. And they had two core insights that were really powerful before they stepped out into the top right quadrant. And those two insights were a bet on selection, so conventional wisdom in food delivery. At that time was just, we're going to have 40 restaurants. That's going to be all we need to scale our business, and that's great. They decided, hey, what if we had 400 or 4,000? And when you do that, you hit the app, and you actually convert to an order with a higher rate of frequency. And when you have more engagement, you have more retention. With more retention, you have better LTV. And all of a sudden, DoorDash could spend more money on attracting customers, way more aggressively, but also way more profitably than people would have expected from the outside. The second insight they had was in suburbs. And again, the conventional wisdom at the time was dense urban markets is where the money is, and that's all well and good. They went out to the suburbs, and they had a couple kind of sub-insights. The first was delivery times were actually pretty comparable. There's no traffic. So even though they drove further, they got to deliver at the same rate. Everybody everywhere eats 3 times a day, so restaurant density wasn't as far off as you would think. And then also, the average number of folks in a household was much higher in the suburbs. And this was the key part, the average order value of a food delivery order is the primary determinant to good unit economics. And so when they went into these suburbs and it was a family of 4 or 5, the orders were much bigger, the economics were much better. And so they had old markets that were profitable, they had newer markets that were scaling there quickly, And that's when they convinced us, that this business was highly viable and it was about stepping on the gas. And now fast forward to today, it's an $85 billion company and still growing pretty quickly. But you don't have to grow that quickly, which leads us to Spotify. So we were lucky enough to lead a $1 billion convertible note into Spotify in 2016. And basically, Daniel called us and his competitive set was changing. It was no longer Rdio, Grooveshark, SoundCloud, Deezer, all these companies, Pandora. It was Apple, Google, Amazon, and these smart speakers were coming out, and who knew how strategic it would be to those guys over time. So we had to capitalize accordingly. And I think the most interesting thing about that deal was they never really grew that fast after that. And the reason was they had unbelievably rigorous LTV to CAC frameworks that they used. And so this was spearheaded by Barry McCarthy, then the CFO, but also a lot of his team came from Zynga and other gaming companies that I kind of view as like the most rigorous go-to-market in internet. It's really good DNA to bring onto your teams. But they'd spend as much as they possibly could within this framework, no more. And by the way, it wasn't just the aggregate LTV to CAC, it was the paid, not the organic, and then the marginal, not the average. And so they had a really rigorous sense of root truth in a way that wasn't diluting themselves, and they spent as much as they could down to 2.5, and as a result, they compounded like this for a really long time. And again, the results of that are staggering. So it's about a 20x over that period with 20% annual CAGR growth. And so I think the big takeaway for me is grow as fast as you possibly can, but no faster, only after you've really nailed it, and make sure time works for you. And so to kind of, animation here, this is the marriage of my two worlds. Kind of on the left-hand side, I'm a student of Buffett. On the right-hand side is the whole startup ecosystem. But either way, make sure you construct your business and the core economics in such a way that time is your friend, and that it doesn't work against you, and ultimately you land in that bottom right quarter and lead to your own demise.
Thank you, Jared. So we're going to look at another layer of tools to use financials to help figure out, or is the company more like Bird, DoorDash, Spotify? Because it's easy to say these things. Obviously, we'd all rather end up being, no one consciously chooses to be WeWork or Bird. But what's interesting, especially about both those examples, both WeWork and Bird, is that it wasn't what I call a random failure. It was knowable in the numbers. So let's look at the numbers. So I like to think that when Keith was talking to John Collison, he talked about the quote that, I can't dream in numbers, something like that. And that's fine. You guys are founders and can dream the dream. But whether you ignore financial reality or not, it's not ignoring you. So I like to think that financials are like gravity, where it's just a force of nature. It's like a law of physics in business. And it does bring most companies down. You can be up in the clouds for a while, but eventually the financials reality is going to act like gravity and bring you down. But you can use these numbers to your advantage. And that's really the point of the second half of the talk, is how to do that and how to not get this wrong. So we're going to start with just briefly reviewing a little bit of what we went over last year. And we're not going to go over raising money or market selection. We're just going over understanding your financials to understand how to know, are you more like Bird or more like DoorDash or more like Spotify? So most of this is exactly what we looked at last year. You should always know your revenue and your cash flow. And I said this last year, and people saw this and would come and show me financials that didn't have revenue and cash flow. So I wanted to just restate this again. Revenue means revenue. It's the amount of money you're making in some period of time. It's not ARR. Just like it says here, those things are indicators of revenue, bookings, but that's an indicator of what your revenue is. And then cash flow, there's no asterisks on it. And the only asterisk might be that you should exclude financing activity. Like if you raise money, I wouldn't include that in your cash flow. But this is not operating cash flow. It's not EBITDA. So if you're a lending business and you have to have money going out the door to support your loan book, or if you have big working capital losses, that's all in cash flow. That's like to put here the total corporate change in cash. And then you should know these numbers. Knowing them means if I ask you what was your revenue and cash flow last year and this year, you can answer. You don't need to go look it up. It's not in a data room. You don't need to ask your finance person. You know. That's why it says always know those numbers. At least those 4 numbers. Revenue and cash flow last year and this year. You really should know it for this quarter. Now, sometimes when I talk about things like this, people say, that means, David thinks we need to be profitable all the time, or David thinks we should grow slowly. Let's look at what David actually thinks. So this financial focus, you cannot have revenue. That just means you know what your revenue is, and it's zero. That's okay. You still know what it is. And we talked about LinkedIn last year, that LinkedIn critically figured out that the way its unit economics were going to work was it needed to crack the code on viral growth. That was what was critical to nail before it scaled. There wasn't a way to do paid acquisition, at least for the early part of LinkedIn. And so they could have had revenue faster and just lost money faster and eventually failed. Instead, they stayed slower. They stayed in that lower, which quadrant is it? The lower left quadrant, figuring out how to nail viral growth. And meanwhile, they had no revenue. You can also have losses, like DoorDash had significant losses. Probably invested over $1 billion in growth. That's okay. That's not inconsistent with the financial focus. And in fact, having this financial focus can help you identify problems like, are you more like Bird than DoorDash, or more like WeWork than DoorDash, before it's too late? Now, there's a few things that are not allowed with a financial focus. If you don't have financials, you don't have a financial focus. If you have what I call fake financials, that doesn't count either. If you don't know what your financials are, you might as well not have them. Then the third point I added here is if you're spending on customer acquisition, there's a few refinements I wanted to emphasize. You should know your paybacks. Payback is a cash measure, cash. And we're going to come back to how this can trip people up in the next few slides. I mentioned last year this concept, and so did Jared, of paybacks on the margin. I find almost no one does this, and I wanted to elevate it here as this is a basic concept. It's not something to do later. So payback on the margin means, let's say you're an enterprise company, and you've got some growth in revenue from upsells to current customers, and some companies just come to you because you have good press. That's fine, but none of that's in your payback on the margin. The payback on the margin is the last salesperson you hired, the worst salespeople you're hiring, the ones on the margin. What is the payback to those salespeople? And then if you're looking at it on a cash basis, you have to include all the costs of hiring them, the cost of recruiting them, the cost of training them. That's all cash out the door before you're getting any cash back. So that concept of cash on the margin, this is a basic concept. If I had to pick if you knew your average payback or your payback on the margin, I'd pick only know your payback on the margin, because this is one of the key things that helps you understand, are you Bird or are you DoorDash? And then this kind of, I'd like to think it goes without saying, but I'd like to say it anyway, that fake paybacks, like if you're doing it wrong or in some kind of fundraising mode, that's not helping you. Or at least, as Jared alluded to also, it's kind of, we all understand the fake it till you make it some, but if you're conning yourself, that's not going to help this business succeed. So I wanted to look at a real example. And the financials we're going to look at here they're changed enough from a portfolio company that it's hard to tell who it is to protect the guilty. But I also wanted to go over this example because it's hard. It's easy to say things like, fly the plane with the right altimeter and so on, but obviously it's hard to do in practice, or people wouldn't end up like Bird and WeWork. Because again, the people at Bird and WeWork, they're not dumb people, and they didn't intend to just light billions of dollars on fire. So let's look at some actual financials and look at how easy it is to make these kind of mistakes and try to reduce the mistakes. So these financials we're going to look at, I said, at first blush, it's all good. And they presented to me 4-month payback, which is an exceptional payback. So let's look at their financials. And when at first blush, a lot of things look good here. If you look at the contribution, the way I look at financials, contribution margin last year, so these were actuals, because this was earlier this year, $15 million in contribution margin, $1.6 million in sales and marketing. That sounds awesome. Like, if either of us look at that, we might think, we're not sure we believe it, but these were actuals. So if this is going to be what I call fake financials, which is, I think, worse than just not having financials. One other thing that was positive here is, it had an EBITDA loss of $15 million, but it added about $15 million in revenue year over year, and with this really high contribution margin, 66% contribution margin. So this looks great. This looks like, well, certainly better than DoorDash, better than almost anything we see. But let's now look at the rest of the story, or what I call the gravity-adjusted financials. And let's look at what the payback actually is. So the first thing I did with the financials here is I put them in millions, because this drives me bananas when people put too much data on the page, because it is a symptom of not getting to what is the truth we're trying to get to. You don't want to obscure it. So here we've got half as many numbers, but you're going to see more data on this page. So there's a new line here, cash flow. Now, sometimes cash flow is very close to EBITDA, and then the distinction isn't that important, in which case I just report cash flow. You should never just report EBITDA. Now here, notice that cash flow is a lot different than EBITDA. This is it. I wouldn't even call it a red flag. I would just say it's massively informative. And if there's a big difference, again, why are we even talking about EBITDA? Just remember, we had two key numbers, revenue and cash flow. Let's just look at the cash flow. Now, because the cash flow is so different than EBITDA, this should make us really question what's going on with that contribution margin. Because this is showing 15 million, just looking at 2024, 15 million of contribution margin, but you notice it's 15 million difference in cash flow and EBITDA. So one could ask, what does this 15 million mean in contribution margin? We don't get the money. Like the cash contribution margin looks like it's about zero. Now that might be an overly harsh way of looking at it. So maybe it's the right number somewhere between 0 and 15 million. But if we're thinking about payback, payback is a cash concept. It's paying back cash. That's just the first adjustment here, or first danger sign. The next thing is, look at, again, just looking at 2024. Look at this, I changed it to, instead of saying sales and marketing, fully loaded CAC. So that other number that was 1.6 million for 2024 sales and marketing, that's a fake number. It's totally irrelevant when you're using it in the context of payback, because it's about 1/3 of the cost of actually acquiring a customer. So, okay, now we're looking at more real numbers. These numbers together, we've got, even without doing any other analysis, we've got, last year the company spent about $5 million on CAC, on customer acquisition, and its contribution margin was probably 0 on a cash basis, and we could maybe say it's somewhere higher than 0. Maybe if it was 7.5, somewhere between 0 and 7.5. But it doesn't have any meaning to not adjust it for cash. So this is a company that actually, to me, once we've done just a little bit of poking at it, this is Bird. This is WeWork. But both the other colleague that I work with and the CEO, these are smart people that were really trying to do the right thing. One thing I encourage you all to do is, if at all possible, go to Reno's talk tomorrow on financials and reporting and metrics. This stuff is hard. It's not like the company meant to have the fake payback and the fake financials, but they were way off. And because it was off, this company, let's see if I can get this pointing right, they thought they were here. They thought they were really ready to scale, but instead they were here. What they need to do is realize they're actually, best case, here, figure things out, and then, you'd rather grow faster than slower, but if you don't have things figured out and you start accelerating, you are Bird. You are WeWork. By the way, in this analysis, the other thing that this doesn't look at all, what we're looking at here, this is just eyeballing average payback. So if this is the average payback, the marginal payback is almost certainly significantly worse. So now you've kind of got the context of, if you step on the gas with this company, you are, gravity's a bitch. You're going to crash big time. So these might be fairly basic concepts, but they're hard to apply. And hopefully you can come out of this thinking or getting some tools and at least inspiration of how easy it is to be in the fake payback, fake financials, even if you're trying to have real financials. Also, this concept of the payback on the margin is so important. And without the right instrumentation, you don't even know where you are on this map. We have a few minutes for questions, but before we have any questions, I want to see if my buddy Jared has any advice to help.
I think we should have called the talk "Gravity's a Bitch." I think that was probably the right way to do it. No, look, I think everything he said, I feel emphatically. It's just when you go speak to an investor, if it's not clear that you've already thought through these issues, it's clear that you're going to go off that cliff later on. And so I just think the most important thing here is to just play skeptic with yourself as best you possibly can and get to the bottom of root truth before you I mean, you're capital allocators too, right? Like you're allocating $1 into sales and marketing or R&D or anywhere else. You're also investors. So you have to have the right facts before you make any of those decisions.
Any questions in the audience?
Hey guys. Is it me?
Go ahead.
Hello. Thanks for the talk. It's an important topic for those of us that want to keep companies alive for a long time to come. I'm curious, as you think about this advice, it does stand, I think, in pretty high contrast with what we're seeing in the AI boom, where there's enormous costs for servers, for compute, for training. There's massive, massive growth, but the numbers aren't typically positive if you look at, OpenAI or even a very, very large, pinnacly successful companies. So I was wondering how you might advise someone sitting in the audience feeling some cognitive dissonance over what we hear you saying on stage and what we're seeing kind of playing out in the AI boom.
You want
me to take it? Yeah. It's a great question. I'll just tell you what we've done, right, in reaction to all this is not very much. We have a couple of investments where we feel like we've been able to get to line of sight over a longer period of time. Like I mentioned at the jump, it's not about having a lot of cash flow today. It's about us being able to analyze the path there and having enough data points to get us conviction in that. But that is few and far between. The numbers are screaming on the top line. They're hemorrhaging on the bottom line. There's a lot going on. And so I think as a founder, it's stay in the game as long as you possibly can, because a lot of those problems, you can see the trend lines on gross margin with token costs and all these things. They will solve themselves over time, but don't die in the interim, right? Make it to that other side. And then when it comes to growth capital, you have to have a credible case to why that widget can really compound over a long period of time.
Yeah, I would add, it is a good question. And I would come back to this slide, that there are many businesses where it can be very rational to spend a significant, there's a lot of businesses where you have high fixed costs and you have to spend you can have losses and not have revenue, but you still have a plan and it should be a coherent plan. So and I would say the more you're spending and the more you're going in some ways out on a limb without revenue or revenue that's well under your costs, the more you should have this third point of you should think about what assumptions do I need to get on top of that. Eventually, you want to turn those numbers around. So there's never a reason to have fake financials. Like what's on this slide, these never make sense. Even if you're spending on customers that don't pay back, maybe you're just trying to learn, or you need to get to critical mass and have losses in a market, that's fine. So the message of this talk is, again, it's not that you need to focus on thinking small, having revenue, being profitable. It's that you just need to have the right instrumentation on the plane, and you should have rational assumptions like DoorDash did about investing into growth. I'd say Uber had the same, and we talked about that. So I think it is a good question, but it would be a huge failing on our part if we left you with the belief that running a business with losses, either because you've got to take market share before it makes sense to flip things around like LinkedIn, or that you can run, like for both DoorDash and Uber, it wouldn't have made any sense to try to be cash flow positive as they grew. It made sense for them to invest billions ahead of profitability. But these were very clear-eyed companies with what assumptions they needed in the future. No fake financials. Okay, how about in the back?
I had the same question.
It's a good question. I can try to answer it again. Kind of like run the model a second time and see a different result.
Okay, last question.
Dave, thanks. Just really quickly, in that example, you mentioned the founders, smart people. How did they make that mistake? Is it just omitting that line, the cash flow line, or was there more to it?
Oh, there are a lot of things. I think that it's one thing I definitely respect, and I talked about this last year, is there's a psychology of person that becomes a founder in particular, and I'd say a CEO in general. And you need a lot of reality distortion field. And thinking about gravity is hard to reconcile with dreaming the dream and having a reality distortion field. And my message is not to take that away. You want to dream the dream, and you want to be an optimist. But as even Elon says, there's some laws of physics which are just there. And so this is why this message of knowing what your financials are. So for example, where that gets mixed up is what that company was doing was, it was in happy thinking, well, I'll just take a small amount of spending that's sales and marketing and call it sales and marketing. That's not lying. But if you're really trying to get to the truth of what your payback is, you should be using cash. You shouldn't be just using sales and marketing, but you should use customer onboarding costs and customer support costs. And you need to look at it on a cash basis. So I think what founders need to do to be the best kind of founder, which is definitely someone like Tony at DoorDash, is you can be an optimist and you can dream the dream, but you can also instrument your plane with the right controls. And you need to know some of it's going to be counterintuitive. You want to look at ARR. You want to look at CAR, because it's a bigger number than what's your revenue. And especially if your EBITDA is better than your cash flow, you want to look at EBITDA. So I think what I want to help people do is take the 90% that is the great thing about founders and CEOs, which is being optimistic and this, the productive reality distortion field, but couple it both with a strong team that you really listen to, that is more oriented towards this gravity adjustment, but also recognize as a CEO, if you're just in Adam Newman land, it might feel good for a while. Eventually, it's better to be Tony at DoorDash. And with that, we'll thank Jared and thank you all.
Thank you.